Hello, Arizona, and welcome to this episode of Valley Tucson Real Estate Show. I'm your host, Jayson Bates, the lender who lives in and is a part of this beautiful community we call home, the Valley of the Sun, Phoenix, Arizona. Hey, if you're a first-time listener to this podcast, thank you for taking time to listen to this podcast over all the other podcasts that are out there. I really, really do appreciate that as I try to bring you all the information that you need to know when it comes to your real estate needs right here in the Valley of the Sun, Phoenix, Arizona. If you want to check out past episodes, you can do so by visiting my webpage at www.valleyofthesunrealestateshow.com. From there, connect with me on any social media platform. I am a big Twitter guy. I know a lot of people aren't into Twitter. I don't know why that is, but I'm into Twitter. I really love that because it is a news feed, and real estate is news breaking all the time. So if you want to keep up with the latest news in real estate, check me out on Twitter. And if you're listening to this on iTunes, I almost forgot to mention this, please write that review, as it is one of the only ways that I have to help improve the show and get some feedback from you. If you want to email the show on my website, I always return my emails as well. But I did get a review here recently. It's from, I'm gonna spell this out because I think if I pronounce it, it may not come out right. But it's spelled PHOCK01, and he put on here, really great. Thank you for this podcast, everything about real estate in Arizona, ! Well, thank you for writing that review. I really, really do appreciate that. It's always good to hear from you podcast listeners out there, and kind of makes me feel good that I think I'm doing a good job, but you never know until you hear that kind of feedback. Okay, I'm going to change things up here a little bit on this podcast. I've kind of gone through some things, and I apologize for not having my podcast out there for the past couple weeks. Been kind of busy with a couple other projects, and so haven't had the chance to get back to it. But I love doing this podcast. I feel it makes me a better loan officer and just makes me better at my craft. So I'm going to get back into it here. I've got a couple shows lined up here. But to kick things off, I want to maybe visit every week. I'll try to do a weekly podcast. I know it's not every single Friday or every single Wednesday or Thursday. I'm not on a real schedule as far as that goes, but I'll try to bring you, at least in the beginning part of the podcast, I'll try bringing you all the latest news that I come across, that comes across my desk, and then I'll give my take on that news and what it really means, because I've learned over the past my lifetime, I guess, that news can be a little misleading. So, I'd like for you to hear it straight from somebody who's in the industry. So let's kind of kick this off here a little bit. So one of the headlines that I came across this week was LOs may become general lending officers. Now, there's a lot of push right now on how relevant loan officers are, what our future is in this industry. I still feel that and if you listen to some of my live streaming and some of my other videos or whatever, I've always maintained that there's still going to be a need for loan officers out there. There's still that face-to-face human contact, especially when you're purchasing a home, which is one of the biggest investments you're ever going to make in your life. There still is that need for human contact. So I don't think we're going to get totally away from, I want to say augmented reality, or I don't want to say we're getting away from human contact with some of the technology that's coming out. But when they say this, I think there are going to be some shifts when we look at a loan officer and a loan officer's role, because the article does go on to say that loan officers are going to start providing other financial products, maybe banking products, credit cards, student loans, those sort of things. And that, speaking of banking products, right? Last week we had a big. Well, we didn't have this, but Wells Fargo had a big problem, right? It was broke last week that Wells Fargo, the Wells Fargo scandal, I guess, is kind of the headline there, may have some mortgage fallout. Now, this is a big deal. I don't think the media kind of spent enough time on this. This is huge. Because I used to work at a major bank earlier in my career, and there was always pressure from the bank to cross-sell consumers. So if you get a mortgage there, they want to cross-sell CDs, insurance, automobiles, whatever the case may be. There's a huge push, an incentive to loan officers to create that kind of lead. Even if you go into the bank, even if you go into a local branch, and you go up to the counter and all you want to do is deposit money, you are bombarded immediately as soon as you get in there through whiteboards, through banners, through whatever. You're bombarded with advertising on the other products that the bank may offer, which in all fairness, that's okay. But I think Wells Fargo took it a little bit too far. Now, the crazy thing about this, why I think this is such a newsmaker here that may be swept under the rug, is that 5,300 employees were fired. And let's think about that for a minute. 5,300 employees. That is a workforce. That is a lot of employees. There are many mortgage companies right here in the Valley that don't have 5,300 employees total. So when you look at 5,300 people being fired, that tells me that they weren't all on the same page without some upper management direction. And here you have the CEO, not the CEO of Wells Fargo, but the CEO of that division taking and retiring. And I think she's getting a pretty good golden parachute here. It's like a couple $1 million that she's getting. Here it is. Here it is in the article. The executive in charge is retiring with a $125 million package. So how can 5,300 of your employees be fired and then you retire with a $125 million package? Not saying you don't deserve $125 million. You know, I've kind of maintained that, and I know people may disagree with me on some of that. Some of that is a bit ridiculous, but there could be some justification in those, depending on the numbers and the changes and how profitable that division is or whatnot. But how do you get 5,300 of your employees fired and you get that? Kind of crazy to me. Now, with that being said, the reason it may have some mortgage fallout is because the CFPB is now looking at big banks and how they cross-sell and how they compensate their loan officers and whether or not it's ethical to be doing so. And anytime you have the CFPB, remember the CFPB, and I'll get into another one of these headlines here, the CFPB, the Consumer Financial Protection Bureau, there's nobody regulating them. So they kind of have free reign. So the banks, I think, and Wells Fargo kind of brought it to light here. I'm sure Bank of America will be looked at. I'm sure that Chase, maybe even some credit unions will be looked at through these practices. And that could have some implications on mortgage lending and cross-selling. So stay tuned for that. So I've had over the past week here, I've had some clients who have had some credit challenges, and there's really no direction. I want to speak of this credit challenge here because credit challenges are one of these things that consumers don't know where to go unless they need some direction. They need some education. They need to know what is truth and what is not truth. And unfortunately, there are a lot of used car salesmen in the credit repair business. And so a lot of consumers get led down roads that are not beneficial to them. And so credit report, there's an article here. There's a reporter. He's with, looks like channel WHYY TV in Philadelphia. He found that he was, his credit report was horribly incorrect on a background check. And it prevented him, it looks like it prevented, it doesn't really say here in the article, but it does look like it may have prevented him from getting a job. And you may have experienced this in the past. There are some checks and balances. Credit report agencies, there needs to be some reform when it comes to credit reporting and the accuracy of the credit reports. I've said this for quite some time. Credit reports are just a snapshot in time. It's not fair. It's not fair to the consumer when applying for a loan because the totality, the whole picture is not necessarily looked at. It's just the score. However, these are the rules that we play by right now. And so it's super imperative that you are out there looking at your credit, getting with somebody like myself who's very experienced at looking at the credit and what underwriters are going to be looking for and what you can do to help influence your credit score for the better so that you can get a better deal for whatever it is that you're looking for. So I want to kind of point that out there because credit reporting and I see these headlines all the time of the inaccuracies within credit reports. I've seen people with 750 credit scores have inaccuracies on their credit report. So just because the credit score may be good doesn't mean that you may not have inaccuracies on your credit. So do check your credit report, and you can get your free credit report once a year. Go to myfreecreditreport.com, or a lot of times lenders send the credit reports. If you apply for a loan, they'll send you a copy of your credit report. Okay, the next thing here, more pre-purchase education may be on the way. This, I think, is a good thing. When I'm speaking of, or when I say that headline there, some of you may be saying, well, what is that? What is education? What are you talking about? So some programs require that if you're a first-time home buyer or even a second-time home buyer, that you get home buying education as part of the requirement to obtain the loan that you're trying to get. And there have been studies out there that show that by having pre-education, home purchase, pre-education, that you are 42% less likely to default on that loan than people who have not had that pre-education. So we may start to see more and more pre-education. Now, this is kind of a good thing, in my opinion, because if we start to see more and more pre-education, then we may start to see opening up of the guidelines a little bit more, and the digging a little bit deeper into credit and a little bit higher risk, and that could be offset by having this pre-education. I used to use pre-education. This is kind of dating myself here a little bit, but about 15, 20 years ago, I used to use this pre-education classes as a compensating factor for loans that might be marginal as far as being approved or not approved. So pre-education does carry a lot of weight with lenders and with underwriters. It does make them aware that you are aware of the risks and your responsibilities to a mortgage. So it does make the underwriters feel a lot more comfortable with approving a loan that might be on the borderline. So if you're on the borderline and you're not dealing with somebody like myself who maybe can suggest these types of things to help get you over that hump and get you approved, maybe you want to suggest that to your loan officer. Although if you're doing that, you're kind of doing their job. It's not a good thing. Okay, let's move on here. The House Financial Services Advances Dodd-Frank replacement. This is something that is going on, and I keep hearing this. If a Republican gets voted in, then the Dodd-Frank may be overturned. And look, there are things with the Dodd-Frank that I think are going to stay. There are things that I agree with on the Dodd-Frank Financial Reform Act. There are things I totally disagree with on it. There does need to be some change to that. One of the things as part of this House Financial Service, it's like the Choice Act of 2016 is what they're kind of labeling this as, is that they want to have a regulatory party that oversees the CFPB. So the CFPB right now has a lot of power, and it's not very consistent. And that's one of the complaints from lenders, that there's inconsistencies within some of the rulings that CFPB has made when coming down on some lenders. And so having the regulatory body who would regulate or oversee the CFPB, kind of keep them in check, would create some more consistency within the decision making. Now, Democrats, everything's political here, and I kind of hate that, but Democrats vehemently opposed the bill, saying they want to expand the powers of the CFPB, while the Republicans want to have some oversight on the CFPB. So, I don't know what the right answer is. I do think the CFPB has a little bit too much power. I do think there are some inconsistencies in what they do and say and what they rule on, penalties, that sort of thing. So I do think that there needs to be some consistency in there so that we as lenders can better assess risk and then make more loans or make more programs for consumers, which would open up the market as well. Now, with that being said, there are another headline here. Will homeowners continue to decline? There's been a lot of there's been an attitude shift, and I've said this here for the past 3 years, even before that. Really, we were witnessing when this economy collapsed. we were literally witnessing a change in attitude toward real estate in the United States. I've maintained that since day one. I still maintain that. I still think that there's a little bit of an attitude shift in real estate and what it means to the consumer or what it means to the public. And we're still seeing that. Now, part of this article, I think this is where it gets a little misleading. Although I believe that, to kind of segue on that, there also is a lot of misinformation out there as to what you can do to purchase a home or what it takes to purchase a home. There was a study out here by the National Association of Realtors that nearly 50% of those surveyed said they strongly agree that now's a good time to purchase a home. But why aren't they purchasing? Why then we have articles that say, that homeownership is at an all-time low? Well, that's because nearly a third of those people surveyed thought that you needed 20% or more to put down on a home in order to purchase. And even a bigger percentage of those think that you need to have a ridiculously high credit score in order to purchase a home. So it's like one of these unobtainable goals. And this is the purpose of this podcast, right? This is the purpose of this podcast is to get the information out there that you don't need 20%. You don't need to have, stellar, flawless credit. I help many people who do not have perfect credit and put less than 20% down all the time. In fact, I've helped people with down payment assistance who have walked away from closing with money in their pocket. So, and right now with rents as high as they are, I don't know why more people aren't purchasing, to be quite honest with you, other than the fact they may have some credit issues in the past, bankruptcies, foreclosures, that sort of thing. But with rents here in Arizona, they're just ridiculously high. It's really at that point, why are you renting when you can purchase? So spread the word. You don't need 20% to put down on a home, and you don't need to have just ridiculously high credit. Okay, Regions Bank, latest to pay a huge fine, FHA. It's getting ridiculous here. I mean, it just seems fine after fine after fine. They paid $52.4 million in a fine to HUD because they didn't follow FHA guidelines. So it's just one of those weeks. I mean, every week I see these banks paying these fines, and it seems like it just doesn't bother them. It's kind of weird, to be honest with you. Okay, so last week too, there was an article or a headline, major headline. It hit the national news pretty heavily. Political pundits, weighed in on this on both sides of the fence. And that was American families finally got a big pay raise, right? They got this I think it was 5.2% year over year increase in income. Now, the article didn't go into where this is coming from and who's actually the beneficiary of this pay raise. And it also didn't go into what that means. So I'm going to give my kind of 2 cents on this whole article here. First of all, the income right now is not where it was pre-recession. So in 2007, median income was higher. In fact, I think it was $57,423 according to this article here. I don't know exact number, but I'll trust this article is pretty accurate here. It's from USA Today. And then now it's less than that. It's like 56,000 and some change. So it's not quite there. It's like $1,500 short of what it was pre-recession. So although we've had an increase, it's still not above 2007. Yet home prices are pretty close, not quite to 2007. We're probably 2003, 2002, maybe in 2004 in some areas of the valley here. Price points. And the cost of living has gone up. Healthcare has gone up for a lot of Americans. Food prices have gone up. Gas prices, I don't know what the gas prices were, but certainly electric bill, that sort of thing, those have all gone up. So there's still a lot of squeeze on that income. And for that reason, yes, we're moving in the right direction. Yes, it's a step in a positive way. Which I like to see. And I've always said, hey, as these incomes go up for Americans, then employers we'll start to see the housing market kind of level off, and employers will have to start competing amongst one another's within their industries to maintain and retain employees. And right now, they've kind of had the pick of the litter. You could quit. Okay, we'll replace you. But with these increases in pay, I think that it'll be a lot more competitive out there, which will help the overall economy, which will help the overall housing industry. So I think this is good. It's a step, but it's only a step, and it's a small step at that. Because I saw another report that said that but pre-recession there were 60%, I guess, non-workforce, meaning people weren't really looking for a job. Now it's 66%, so that's actually gone up. More people aren't looking for jobs now than weren't looking for jobs pre-recession. Okay, so now I want to go over a couple things here, and I've got all my notes here. So if you're watching this video on YouTube, please subscribe, share with your friends. But I want to go over a couple predictions here and how they relate to what we're doing. And I know I'm running a little bit late on time. I know it's 20 minutes. I try to keep the podcast at 20 minutes or less, but there's a lot of information here, and I haven't done this in a while, so I want to make sure this information gets out to you. Okay, so 10 bold predictions here. And I may not go through all 10 of them because some of these are kind of just a bit ridiculous here. Conservatorship era comes to a close. This is what I was speaking of. I think that we'll start to see more and more of the lending guidelines start to open up, especially with, if they're talking about doing education as a pre-purchase requirement, then they're going to be willing to dig a little bit deeper on some things. Bye-bye bankers. I kind of touched base on that with Wells Fargo. There's going to be a shift there when it comes to that, and we'll see what happens. I don't think bankers as a whole are going to be out of the mix here, but I do see a more limited role. And we've seen over the past few years, a lot of people just don't trust the banks. They don't trust the banks. And when you're making a big investment, a big purchase, such as a mortgage or a home, having somebody you trust is vitally important to that role. Hello, brokers. So bye-bye bankers, hello, brokers. I don't agree with this one. I think there's going to be more mortgage bankers, not brokers. And the difference between the two is a broker makes a loan with the intent of selling the servicing rights somewhere else. HUD has made numerous statements that they don't like this model at all because it just lends itself for the opportunity for a broker to commit fraud. Because if their hands are wiped clean once a file closes, doesn't mean that the file was done correctly. And so HUD wants some ownership of those brokered files. So HUD doesn't like brokers. I don't really necessarily think that brokers are going to come back, but I do think non-depository bankers, mortgage bankers, more specifically, I do think will still maintain a large market share of the mortgage. The return of a functioning subprime mortgage market. Now, this one, again, I don't know if I 100% agree with. Some would argue that FHA is subprime because of how low they dig on credit scores. So subprime really didn't go away. It may have been redefined a little bit, but subprime in the grand scheme of things has not gone away. Maybe we'll see some alternative types of products making their way back. And I'm starting to see that already with stated income, bank statements, that sort of thing. But I think Alt-A is kind of what we in the industry kind of refer to those programs as being. I do think we'll start to see a resurgence of those programs versus, subprime. Subprime just seems to carry a negative condensation. The secondary market doesn't really like that. Expanding conforming loan standards. We are seeing that. We are, and I agree with this one, we are seeing expanding in conforming loan standards. We're seeing Fannie Mae making some strides in credit and income. There will come a day where there's some automation. If your employer files your income with it's kind of like the work number when they verify your employment. If they file your income through ADP as an example for pay, then and ADP reports to the IRS, we may be able to pull your income information straight from the IRS. Therefore, not asking you for pay stubs, W-2s, tax returns. We can all get that online through the IRS. there's some security issues going on there that I think need to be addressed before that actually is fully implemented. But I do see expansion in those areas from Fannie Mae and Freddie Mac. Do-it-yourself tech will replace loan officers. Kind of touched base on that a little bit in the beginning there. I don't think it's going to go away totally, especially for the people who need direction. And I don't know that the public really wants this either. There's a huge segment of people who just need education. You want to know what you don't know. And so you're not going to get that from a computer. Because it's very finite. It's very, it's only as good as what the program will allow it to do. There are always going to be these areas within lending that people can qualify for that a computer is just not going to be able to analyze. So I do think that there will be a market share for this type of technology in our industry. I don't know that it's really going to take over anytime soon. Now, this one is very interesting here. This kind of segues into that last one there, which is AI, which is artificial intelligence, will replace human underwriters. We kind of have seen that with credit reports, right? I talked about that a little bit earlier. Credit reports go on credit scores. When I first started in the industry, we had to manually do a CAP and BAP. CAP, which was a consumer analysis profile, and BAP, I think, was borrower analysis profile or something like that, or buyer's analysis profile. And so we had to look at the overall credit, determine the risk, and that risk was specific to the lender. Now we use kind of a generic credit score model. Most lenders are on the same credit score models, although they do vary between lenders based on risk. But I don't know that we'll start underwriters. We do have automated underwriting with LP, which is Loan Prospector. That's a Freddie Mac version of automated underwriting. And then we have DU, Desktop Underwriter, DO, Desktop Originator. Those things are automated underwriting engines, but again, an underwriter has to come back and verify the information is accurate. So I don't know that we're totally there where we get rid of underwriters, but certainly there are going to be models out there where we're going to see in the future, and this is part of the expansion. If somebody's got, a 700 credit score, 750 credit score, and it's a 50% loan to value, and you've got money in the bank, and you've been at your job for 10 years, and your debt to income ratio is 20%, it doesn't take a rocket scientist to say that that person would be good for a loan, especially if they're paying X amount in rent and the mortgage payment is equal to or less than what they're paying in rent, and you can show a history of them paying that rent on time. It doesn't take an underwriter to make that decision. And so there are going to be those common sense loans out there that artificial intelligence, I think, will play a part in, but I don't know if it'll take over completely. Marketplace lenders will not be major players in residential mortgage. There's a big movement right now, crowdfunding and stuff like that for some of these investment opportunities that are out there. This, I still think, is yet to be determined. This might be way off in the future. These are bold predictions. But I don't know that that's something that's going to happen anytime soon there. Compliance will force e-mortgage adoption. Compliance is a big issue for lenders, and lenders spend a lot of money on compliance to the point of frustration for you, the consumer. So with the TRID rules and some of these other rules that are out there that are acted to or put in act to help protect the consumer are logistically a nightmare for a lot of mortgage companies. A lot of resources go to that. So I do think that could help and be put in place. Now this one here, the last one here, now I'm going to spend just a few minutes on this one, but this one's a big one for me. And I've been talking about this because I've had this happen here in the Valley this past week. And this is appraisals will become obsolete. And I've had over the past, month here, I've had quite a few appraisals coming in low, appraisers not really looking at the overall market or not familiar with the market. Appraisals are subject to one's interpretation. And that interpretation is based on professionalism, experience, and a few other factors that I'm probably not mentioning here. That's a problem. And so there's no consistency. If you're a homeowner or you're one to look to purchase a home, of course you want If you're purchasing a home, you want the home to appraise less because that means you may pay less for the home. If you're a homeowner, getting an appraisal that's far less than what you feel the value is insulting. And so they always say, hey, look, we're looking at the comps. We're looking at something that's happening currently out there. Doesn't mean you couldn't sell it for what you feel it is. If you do feel that you have that value, then sell it. But the market, the comps support a lower value. This is a huge problem. And to segue on this, appraisers right now in the Valley, we don't have it so much here in Phoenix. Appraisals are still okay as far as turn time goes, but we are starting to see within that profession, appraisers starting to exit the market. And that's creating a backlog. We're starting to see turn times on appraisals get further and further out. I think in some parts of the country, I thought in Portland, Oregon, for you listeners up there in Portland, I think, from what I was told, it could be like 60 days or something like that, over 30 days for sure, to get an appraisal back. That is crazy. Here in Arizona, generally about a week, but I'm starting to see 2 weeks for a turn time here in Phoenix, Arizona. Certainly in the outlying areas of maybe in the high country, Flagstaff, Payson, Prescott, maybe in Tucson, it can take a month to get an appraisal back. So there's a shortage of appraisers that are out there. And that is causing some tension, because when there's a shortage of appraisers out there, then the appraisers know they have the upper hand and they're going to be conservative because that's their license is on the line. And so they're not going to stick their neck out too often to get an appraisal done. And you wouldn't want that done anyway, of course, but you want a fair appraisal. And when you don't have the level of experience in a pool of appraisers, and you have some new appraisers that may be entering into the market, which there are few and far between of those, but you may have some inexperienced appraisers appraising a home who have no idea of your market. So as an example, you may live in Scottsdale, Gilbert, you name the city, and you may have an appraiser that travels clear across the city and then is going to come over and analyze your market and your neighborhood. Anybody can look at the comps. We all can look at comps. This information is on Zillow. This information is public record on Maricopa County. We can pull this information up and look at them and say, hey, this is a value. But the real skill in appraising a home is looking at the details, looking at where the market's going, look at how it's trending, looking at making the adjustments for time, making the adjustments for location, making the adjustments for schools, for amenities within the home, landscaping, whatever the case may be. That's the real skill in doing an appraisal. And so I've done some podcasts on appraisals before. Do check those out. But I've seen this trend here where we're starting to see the appraisal process taking longer. We're starting to see appraisals coming in lower, which is not a good trend. It's not a good trend. And the appraisals coming in lower. I want to make mention of that real quick, because I've mentioned this before on this podcast, that there are a lot of realtors out there who just, in order to get the listing, your business, if you're a homeowner looking to sell, they just will tell you what you want to hear. If you say your house is worth $200,000 but it's truly worth $175,000, the appraiser or the realtor says, "Yeah, I'll take your listing at $200,000." Sure, as if you know the market better than the professional, so to speak, knows it. In order to just get that listing, get the sign up, and get some calls, get some leads from that sign, that's what realtors want. And it takes a rare realtor to tell you, you're way out of whack. I'm not taking the listing because my reputation means something to me. If you want to sell it for $200,000, you don't need me to do it since you know it all. You sell it for $200,000. That's a rare realtor. And so I fear that some of these appraisals coming in low are a result of over-promising and under-delivering by the realtor. But then again, there are some that are just coming in low for no apparent reason. So, and I think that's partially due to the competency of an appraiser or how experienced they are. So those are the things that are the headlines out there. I hope that I gave you some information or some insight as to what I see happening out there on a daily basis. Again, I hope this is good. This is the first time I've done the news by myself, so hopefully I gave you guys some useful information. I'll try to do this once a week. I went through a lot of headlines this week because it's been a while, but I'll try to narrow that down to the top ones and give my opinion on those on a weekly basis, in addition to bringing you other content that you can use when making a decision to purchase a home right here in the Valley of the Sun, Phoenix, Arizona. So thanks for tuning in. Thanks for listening to this podcast. Don't forget to write that review. I am on iHeartRadio, TuneIn Radio, and Google Play Music. So if you're listening on those platforms, thank you. I appreciate that. And if you're listening on iTunes, please write that review. I really do appreciate that. And I'll read it on the next podcast or the next time I go on the air. I'll be sure and read your review. So appreciate that. Again, visit my website, www.valleyofthesunrealestateshow.com. From there, connect with me on any social media, especially Twitter. Follow me on Twitter. A lot of information on there. All right, everyone. Have a great day. Have a great week. And I hope to see you out there shopping for a home very soon. Take care, everyone. Bye-bye. Jayson Bates, NMLS 220798, mortgage banking license 1796, equal credit opportunity lender. Sound effects provided by soundj.com.